All right, great. So starting off the next question here, we're looking into Cori appliances. Let's get a strong understanding about what is there here. So starting off, what we're looking to do is to first go through the requirements. In the first requirement, we have to tell preconditions for the audit. And next, we have to write about the 7 audit risk and audit responses. And then finally, we have to talk about what do you mean by professional skepticism and give 2 examples from the audit of Corico, where the auditor should apply professional skepticism. So this is all about the 3 questions that we will be doing. Precondition is before you start the audit, what and all are the things that you need to first make sure of. Right? Only after you make sure of these things, you will start the audit. Okay, first few things you make sure of. So Shravan, before you shifted to Bangalore, what were few things that you made sure of before shifting? What were those things? Yeah, tell me few things that you made sure of before shifting to Bangalore. Few things you made sure of. Did you check the PG before?
Yes.
Yeah, you came once
Yes.
just to make sure you checked where you lived.
Yes.
You checked, you came here, you saw how the setup was, how you will be studying. You checked that as well. Then you ensured your registration happened.
Yes.
Right? Can I say few things you checked and then only you started? Yeah, then only you moved to Bangalore. Can I say?
Yes.
What are the 3 things you checked? Tell me.
First, we got the PG
Correct.
expansion of breathing.
Very good.
And I came here
Correct. You looked at the center here. Okay.
and saw your office.
Correct.
And later on, registration.
Registration, you made sure these 3 things happened, then only you move to Bangalore. Similarly, before you start an audit, guys, you have to check few things are in place, only then you have to start. Now, what are those things that you have to check? First thing you have to check here is that the management is using an acceptable financial reporting framework. That the financial reporting framework that the management is using is an acceptable financial reporting framework. Okay. Second, you have to make sure that the management is acknowledging its responsibility. Its management is acknowledging the responsibility for preparing the financial statement. They are saying, yes, we prepared the financial statement with an appropriate framework. They are accepting that they have done it. Second, they have established internal controls. Right? They have established internal control. They take the responsibility for that also. And next, they take the responsibility that they will provide the auditor with the access to all the relevant information during the audit. So these are the 2 high-level things that you have to be ensured that are put in green. And overall, in the second part, there are 3 more things that you have to be sure of. So these are your preconditions. Firstly, that a financial acceptable financial reporting framework has been applied. Second, we have to ensure that the management is acknowledging its responsibility. That number one, it prepared the financial statement. Second, it has an internal control system in place that it has established. And third one, it will provide the auditor with access to all the information. These are the 3 preconditions required before you start an audit. Okay, let's go through the all the conditions here, Nivan. What are the precondition that needs to be in place before we start an audit?
Yes, so the first one is to determine whether the management is using financial reporting framework that is to be applied.
Okay.
And the second one is to basically obtain the agreement from the management that it understands and recognizes the responsibilities to prepare the financial statements in accordance with the applicable framework. Then the internal control should be necessary for the preparation. The third is providing the auditor with access to all of the information which is required in order to plan the audit.
Okay, perfect. So that is all.
So are these preconditions universal? Like, can we use it for any question?
Any question that asks about precondition, yes, it's an universal answer for preconditions. कोई भी क्वेश्चन में प्रीकंडीशन हो आंसर यही होगा. ठीक है, प्रीकंडीशन यही है. हर ऑडिट के प्रीकंडीशन यही है AA के हिसाब से. तो कोई भी क्वेश्चन हो, कभी भी प्रीकंडीशन पूछे, यही छापना आंसर उधर आंसर में आपको क्वेश्चन पेपर में, यही आंसर शीट में यही आंसर अपन को टाइप करना पूरा का पूरा. ठीक है, so this is the answer that will be standardized. Yeah, Karima, are we clear with this? Before starting an audit, what do we have to be sure of?
Yes, sir.
Okay. Moving on now. Tia, clear with this?
Yes, sir.
Okay. Moving on now. Preconditions required for an audit. First part of the answer is done. It's 3 marks. Next, we'll look into 7 audit risk. So we have to find out 7 audit risks. So you know the drill. So we look into the audit risks here. We'll read it from the start and we'll start identifying the audit risk. On 1st July, you are an audit supervisor. So it is 1st July. Currently, what is the date? It is 1st July. Who are you? You are an audit supervisor. What is the name of your audit firm? Woodward. and you're in the process of auditing a client called Corey Appliances. What is the name of your client? Corey Appliances. What does Corey do? It will sell electronic appliances such as fridge and freezer, TV and washing machine. Okay, the company's year end is 31st August. Okay, when is the company's year end? The company's year end is 31st August. Okay, what is the company's year end? Company's year end is 31st August. Okay. The forecast revenue for the year forecasted is 12.2 million. Total assets are 6.8 million and profit is 2.8. Now, why have they given you this information? So that you may find materiality later on. Right? They've given you all these three information so that you may use it to find materiality. Right? They've given you these three information so that you can find materiality using it. Okay. Later on, you may use it to find materiality. If any item is there in front of you, you can take it a percentage of either of these and see if it meets the materiality standards. So forecast revenue for the year, then assets and profit. These three numbers they have given you. Okay. What are the products of the company? Mainly it sells the fridge, freezer, TV and washing machine. This is the product of the company. So you know auditor, you know the company name, you know what they sell, you know their expected numbers that are about to be. Next, the audit manager of Woodward Co. is set up a meeting with the finance director of the company, which is your Corey Appliances. Okay, that is the first paragraph, nothing complicated. Quickly, let's summarize this one here, Karima. Let's summarize everything that's highlighted. What's the date today? And who are we in the case?
Sir, it is 1st July, and we are the audit supervisor of Woodward,
Very good.
and we are planning the audit of Coley,
Very good.
which is the company that sells domestic electric appliances such as fridge, freezers, TVs, and washing machines.
Very good. What are the forecasted numbers? Yeah.
So revenue is 12.2 million, assets are 6.8, and profit before tax is 2.8.
2.2, 2.8. Perfect. And now there's a meeting that is about to get started. So now let's look into what are the meetings in the meeting. What did they talk about? Let's look into that. The start of the company operates national worldwide. It has 20 branches. Okay. It's located across the country and it sells goods to members and public and to retailers. It has 20 branches. Okay, the company operates nationwide and it has 20 branches across India. Similarly, across that country they have. And they sell it to public also, B2C also, to consumers also, and B2B to other businesses also. So they're saying nationwide, 20 branches, selling to public also, selling to retailer also. Moving on, the company has a return policy which allows the customer to return the goods within 28 days. This is a risk now, right? So if till 28 days happen, you cannot recognize as revenue because the customers can return it. So what is the risk over here? If you look at the company has a 28 return day policy where customers can return the goods if they are dissatisfied. Okay, the customers can return the goods if they are dissatisfied. Okay, 28 days, the company has a 28 days return policy. This is the risk. Okay, why is this a risk? Now looking into why is this a risk? This is a risk because revenue should only be recognized if you're sure that you will not get a refund. And in this case, you can get a refund. So when you are not sure that you may get a refund, you may not get a refund. In those cases, you should not recognize a revenue. So the company should not correctly account. The company should recognize the refund liability, which are expected to be returned. What the current company should do, they should recognize the refund liability. The company should recognize the refund liability for the same as well. Okay. So if the company has not correctly accounted for the refund liability, your revenue will be overstated and your refund liability will be understated. So first of all, what is the risk here? The risk here is that revenue should only be recognized to the extent that it is not expected to be returned. So if a certain percentage the company feels that they will have to return based on past experience, that every year maybe 2% they return customers. If you sell for 10 rupees, 2 rupees will come back. So based on that, they might have to set up a refund liability. There's a risk that the company has not set up a refund liability. So your revenue could be overstated and your refund liability could be understated. So as an auditor, what can you do? What are your responsibilities here? What are the things that you can do as an auditor? First thing, inquire. So basically you're discussing and you're talking to the finance director how the returns policy has been applied at the year end and whether the provision in IFRS 15 has been reflected. So first you're inquiring that how they have applied the policy of IFRS 15. How have they applied it? Second, you are reviewing the assumptions underpinning the financial liability. Whatever the refund liability they've set up, 2%, 3%, 5%, you are reviewing it. You are reviewing the assumptions. And finally, what you're doing, you're comparing the level of post year end returns to the refund liability, right? After the year end, after the year end, whatever came versus how much had liability you had set up initially, and discuss if there were any significant differences. We will discuss it. So these are three things you are doing. So what happens is 28 days you can return the customer, you can return the company the goods that you purchased as a customer. So now what happens is the company, how much ever it expects that will be returned, that much percentage you have to set up a refund liability. So now the problem is there's a chance that they would have not set it up or they would have not adequately set it up. So there's a big risk over there. So what you have to do is you have to ensure that that refund liability is set up. In the first place, you have to set that refund liability. Second, you have to ensure that it's adequate. That is the most important that should be there. So as an auditor, what you will do, first you will talk to the finance director and see that as per IFRS 15, have you done everything or not? Second, what you will do, you review the assumptions underlying the refund liability, because the refund liability is based on assumption. You and me both don't know how much we'll refund this year, right? You'll just look at past experiences and you'll know, okay, out of 10, 5 people will refund, or out of 10, 2 people will refund, ask for a refund and return the goods. So that will be a problem. So you just review the assumptions. Okay, this year you have kept a refund liability of 2%. Why did you keep 2%? Or you kept 5%. Why did you keep 5%? What is the basis? Why did you keep 5%? Second, after the year has finished, see if any returns came. After the year end is done, take whatever returns came after the year end also and during the year also. Just look at the number. Right? Let's assume 25 people have returned and check your refund liability that you had set initially. Initially, you had set only for 5 people returning. But how many people returned? 25 people returned. But how much liability you kept in the site? Only 5 people will return. So now there's a significant difference here. So you will discuss it with the management. What you will do? You will discuss it with the management. What you will do is that you will discuss it with the management. Only 5 people returned. You thought 25 people will be there. You thought 25 people would, 5 people would return. You kept that much money only. Now 25 people have returned. So now you will compare that and you will discuss the differences. Why so many differences happened? Okay, so this is what happens with the refund liability. They are saying historically 5% will return the goods, right? They have to ensure whether they meet the 5% criteria. Minimum they should also keep 5% because the question says 5% will return the goods. So minimum they should keep 5%. So you have to discuss with them that have they kept at least 5%, and if they have not or kept any less, you have to talk that why they have kept less or why they have kept more. You have to understand their point of view. Okay, so that is about the refund liability. You're talking to the finance director, you're reviewing the assumptions, and you're comparing the level of returns that happened versus the liability that you kept. That is the auditor's response. Okay, that is the auditor's response. That is the audit risk, and that is the auditor's response. Okay, that is the audit risk and the auditor's response. Okay, that is the audit risk and that is the auditor's response. Okay.
So sorry, but can you explain the response once again?
Yeah, first you talk to the finance director and you ask him, has he made all the treatments as per IFRS 15? That you inquire with the finance director, and what do you talk to him about? That how the returns policy has been applied at the year end. That how have you applied the policy this time at the year end, and whether the provision in IFRS 15 has been reflected. Have they done it as per IFRS 15? The returns policy that they have they applied it in context of IFRS 15? First thing. Second, whatever assumptions are there around the refund liability, are they reasonable? Whatever assumptions are there around the refund liability, are they reasonable? And whether they meet the at least 5% criteria. Every year up till now, 5% people return. So minimum, have they kept 5% or not? You will assess the reasonableness of whatever liability they have set up. Finally, compare the level of post-year-end returns to the refund liability. Compare what? Compare the post-year-end returns. Compare what? Compare the level of post-year-end returns to the refund liability and discuss any significant differences. Compare the level of post-year-end returns. Okay, compare the level of post-year-end returns to the refund liability and discuss any significant differences. So what you have to do is compare के साल खत्म हो गया, आप बैठ के देखो कि आपने रिफंड लायबिलिटी बनाए थे 10 लोगों की, आपने लायबिलिटी बनाया था और आपने उतना अमाउंट रखा था कि 10 लोग अगर रिटर्न करे तो मैं उनको पैसा रिटर्न कर दूंगा, 25 लोगों ने रिटर्न कर दिया. तो जो सिग्निफिकेंट डिफरेंस आया है, डिस्कस इट विद द मैनेजमेंट कि भाई इतना डिफरेंस क्यों आ गया. These are the three things you do: review the assumption, discuss with the management. After comparing the post year end, after the post year end, comparing the number of returns versus the liability setup. In the first case, inquire with the finance director and ensure that the returns policy has been applied, keeping in mind the provision of IFRS 15. ये सारा काम IFRS 15 के हिसाब से हुआ, जो अजम्पशन था वो सही थे क्या, रीजनेबल थे क्या, 5% का क्राइटेरिया मीट हुआ, और फाइनली जो ईयर एंड होने के बाद जितने भी लायबिलिटी आए, जितने भी रिटर्न्स आए, वैसे जितना हमने एंटिसिपेट किया था लायबिलिटी सेटअप करते वक्त, दोनों को कंपेयर करना है, देखा कि वो कितना डिफरेंस है। अगर बहुत ज्यादा डिफरेंस है तो फिर वी विल हैव टू डिस्कस इट विद मैनेजमेंट। Okay. So these are some multiple things. Do you have to write all of them? No. One or two, if you write actions, we are good to go. Right? But it should match with whatever risk you have identified. You have to match the action with the risk. Right? What the risk was over here? The risk over here was that the risk over here, the company would have recognized the refund liability lesser than it would have, or it wouldn't have recognized it. So the action should be relevant to that only. That the action should be that, okay, the company historically has been keeping 5%. So this year also a discussion should be there with the management to understand the assumptions around the refund liability and assure that at least 5% continuous target of 5% has been met or not. Or what was the fact? What was the reason why they kept 5% or less or more than 5%? They kept 5%. Okay, justified because last year 5% happened, or up till year 5% happened. So your response should be based on whatever risk you have identified. Okay, now as we do few more questions, you will start seeing the pattern. So the idea is to just do so much volume that you start picking up that okay, how it is done. Right? It's just pure volume throwing at you of audit risk. So let's do one more and let's keep looking into this. The company also provides a 6-month warranty. What does the company provide? 6-month warranty on its products to repair any defects on its own cost. Okay, what does the company do? It provides a 6-month warranty on its products, and which requires any repair or defects, it will on its own cost, they will repair and give you, which arise within the warranty period. If anything happens within the warranty period, they will repair and give you. It is anticipated that the warranty provision in the draft financial position will be lower than prior year, as the directors are confident that they have built at a very high standard. So this year they are reducing the warranty provision. The money they keep aside that they will need for repair work, this time they are reducing the provision. Right? On what grounds? There is no solid basis. There is no reasonable reason for reduction. They are just telling that the directors are confident. That is not a reasonable basis. Simply, why are you reducing it? What has happened? That there's a student who's writing an ACCA exam and started bunking classes, not self-studying, and I'm asking why. And they're like, sir, I'm confident I will pass. But there is no reasonable basis why you have started not attending the class and why have you started not doing self-study. Just because you are confident you will pass doesn't mean you will pass. Similarly, just because the directors are confident that the product will be built to a high standard and they are not in the control, they are not manufacturers. If you remember, Corey, they just basically sell all this. They just sell, they don't manufacture. When they only don't know, if they are in not control of manufacturing, how can they claim this assumption? If Corey was the manufacturer and then he told we'll make solid quality, it would still be believable. Someone else is making and you are claiming over here. What is the basis? Right? You're telling fruity is very healthy. You don't even know how, you didn't even make fruity. Right? Some manufacturer somewhere in India in some factory they are making fruity. How can you claim saying that it is healthy? What is your basis? Just because you're confident doesn't mean it's right. Right? Just because you're confident doesn't mean it's right. Just because you're confident about a topic doesn't mean you'll be able to solve the sum. Okay. So confident doesn't equal to reality. Okay. So the same thing over here. The company provides a 6-month warranty on its product. What does the company do? The company provides a 6-month warranty on its product. What does the company do? The company provides a 6-month warranty on its product. Okay. The company provides a 6-month warranty on its product, which require defects to be repaired at Corey Appliances' own cost. Okay. The company provides a 6-month warranty on its product. What does the company provide? The company provides a 6-month warranty. Okay. What does the company provide? The company provides a 6-month warranty. What does the company provide? The company provides a 6-month warranty on its products. What is the risk? That the company provides a warranty. Okay. And they are reducing the warranty this year. That is the real risk. Right? The real risk is the reduced provision, the reduction. Warranty in itself is not a risk. The fact that you're reducing it is a risk. Right? Reduced warranty provision is a risk. Now, why it is a risk? Why is this a risk? This is a risk because the company does not even manufacture the products and therefore they have no reasonable reason for reduction. Right? They have no reason to reduce this provision. There is no logical reason. So what the impact would be that your expenses may be understated. Hence, if the company has reduced the warranty provision excessively at the year end, there's a risk that the liabilities and expenses may be understated. Okay, if the company has reduced the warranty provision excessively at the year end, the liability and expenses may be understated. So the what is the risk over here? That your liability and expenses may be understated. That is the impact that will happen. And as an action, what you should do is, first of all, review the calculation of the warranty provision and assess its reasonableness. Review the calculation and assess its reasonableness. Is it even reasonable? Second, review the assumptions underpinning the warranty provision. Review the assumptions underpinning the warranty provision. And finally, review the level of claims made under the warranty post year end. Right? Review the level of claims made under warranty post year end. Right? Review the level of claims made under warranty post year end and assess the reasonableness of the reduced provision. So, first of all, what you will do, you will review the calculation of the warranty provision and assess whether it's reasonable or not. Right? First of all, you will see, is your provision reasonable or not? They are reducing the provision. Is it reasonable or not? Whatever claims have already come in the year, and then you make the provision, just see if it's reasonable or not. Second, around whatever assumptions are there around the warranty provision, because you are estimating only, review all those assumptions. Does it make sense? Next, review the level of claim made under the warranty provision post year end. After the year end, review the level of claims that were made under the warranty post year end and assess the reasonableness of the reduced provision. Do what? Assess the reasonableness of the reduced provision. What you have to do is assess the reasonableness of the reduced provision. What you should do is assess the reasonableness of the reduced provision. Assess whether it's reasonable or not. Assess the reasonableness of the reduced provision. Okay. What you should do is assess the reasonableness of the reduced provision. Very important. Assess the reasonableness. Is it reasonable or not? Okay. So assess the reasonableness of the reduced provision. Firstly, you are reviewing the calculation of the warranty provision and assessing its reasonableness. Second, review the assumptions underpinning the warranty provision. What are the assumptions underpinning the warranty provision? And next, review the level of claims made under the warranty post year end to assess whether the reasonableness of the reduced provision. So review the level of claims made under the warranty provision. Okay, what is the level of claims made under the warranty provision? So review the level of claims made under the warranty provision to assess whether it's reasonable or not. Okay, review the level of claims made under the warranty provision to assess whether it's reasonable or not. Okay, review the level of claims. Very important. Firstly, reduce warranty provision. We looked into that. That is the risk. Why is it a risk? Because see, the company is not the manufacturer. How can they claim that reduce the provision? Product will be of good. What basis do they have to tell that? So what is the impact over here? That your warranty expenses or your liabilities may be majorly understated. Okay. So what is the response? Review the calculation of the provision and assess whether it's reasonable. Review the assumptions underpinning the warranty provision. Review the level of claims that were made this year to assess the reasonableness of the reduced provision. Okay. Review the level of claims that were made under the warranty provision after the year end to assess the reasonableness of the reduced provision. To assess the reasonableness of the reduced provision, review the level of claims made. Okay, review the level of claims made. To assess the reasonableness of the reduced provision, review the level of claims that are made. Okay, so review the level of claims made. That is about this reduced warranty provision. Next, we look into the next tricks here. A company is based in Europe and its main supplier is in Asia. So goods are shipped to the company's warehouse and are transit in up to 1 month. So 1 month, guys, the goods are in transit. The goods are in transit for up to 1 month. Okay. The risk is that the goods are in transit up to 1 month. Why is it a risk? Because at the year end, there's a risk that the cutoff may not be accurate, as they may not be correctly recorded from the point of dispatch. So see, basically, guys, in December when the goods were dispatched, December 25th goods were dispatched. January 5th it came to your godown. So you will record that the inventory has been received on January 5th. That is in the next year. But that is wrong. The moment the supplier dispatches it, you should record it. Whether you have received or not doesn't matter. The moment the dispatch has gone, you should record it as your inventory. So they would have not done that. They would have recorded in January, but they should record it in December only. The moment it leaves the supplier's godown, the moment it leaves the supplier's godown, okay, the moment it leaves the suppliers go down, Okay. The moment it leaves the go down, okay, the moment it leaves the go down, what you should do? The moment it leaves the go down, you should record it as a revenue, as a inventory. But it will be delivered 2 weeks later. So if December 25th means it will come in January. But you should record it in December only. The moment the supply dispatched, you should record it as an inventory, as a customer. But there's a risk that they would have not done that. Because now it's coming in a different period. So the cutoff will be wrong. Cutoff means in the correct period. Cutoff means things should be in the correct period. December, the goods, the supplier released the goods in December. You got it in January. In your books, you're recording in January. You should record it in December. You should record it as per December. Right? The moment it is dispatched, you should record it. The moment it is dispatched, you should record it. Okay? The moment it is dispatched, you should record it. Okay?
As we said, the moment the goods are dispatched, we should record it. So, if we have recorded it, like it's dispatched on December 5th, and we recorded it that day, but they were lost in transit. So, what will happen then?
You will reduce your inventory. आप उसको as a loss दिखाओगे आप. You will show it as a loss. Because the moment it is dispatched, it's yours. Now, if anything happens, it's on you.
Okay.
Supplier responsibility was to send it to you. That's it. If anything happens in transit, now it's on you. Okay, that is how these arrangements work. So there's also a risk that the inventory and trade payables are understated because you would have not recorded them at the year end. Why would you have not recorded? Because you are thinking it's in transit. It will come in January. I will record in January. But you should record it in December only. So your inventory also will be understated. Your payables will also be understated. Your payables, because you have to pay the supplier also, that will also be understated. Because you'll see when it will come, then I will make a payable. Okay, so the company purchases their goods from its supplier. Explaining us the risk. So what is the main risk? The goods are in transit. 2 weeks they are in transit. So the risk is the cutoff error. The risk is the cutoff error. So what you should do as a solution to this, what can you do? That first of all, discuss with the management at what point are they recording inventory currently? When they are receiving or when it's dispatched? Okay, first of all. Second, review the contract with the supplier to verify the requirements that are in place. Look into the contract. They would have had a contract. The supplier and the customer would have had a contract. Okay, the supplier and the customer would have had a contract. So you look into the contract as well. The supplier and the customer would have had a contract. Yeah, put it there. Okay. The supplier and the customer would have had a contract. No, the supplier and the customer would have had a contract. Okay, the supplier and the customer would have had a contract. So review that contract as well. Second, also review any controls that the company has in place to ensure that inventory is recorded from the point of dispatch. Does any control is there in place? Like the moment it dispatch, some notification comes. The moment, like your goods are out for delivery. Remember, it comes when you order from Amazon, it comes so many times. It's the goods are out for delivery. So the moment they're out, you should record it as your inventory. Okay, the moment they're out, you should record it as a delivery. That and now it's your good. Okay, that is what the logic is in the accounting sense, that there should be some control, right? You got an SMS that your goods are out for delivery on WhatsApp or normal text. You got a message. So that was the control, that was the notification in place. So you should see, does the company has any control that helps them ensure that the inventory is recorded right from the point of dispatch. Is any control as such in place? Is there any such control in place? Okay, is there any such control in place? Okay, is there any such control in place? Is it there or not? Okay, any such control in place? Is it there or not? Okay, is there any such control control in place or not? Okay, is there? You have to look into that. Is there any such control in place or not? Next, the audit team should undertake detailed cutoff testing at the year end and the sample of shipping documentation immediately before and after the year end relating to the goods from its main supplier in Asia. We should do detailed cutoff testing of the purchases of the goods at the year end. Okay. And also for a sample of shipping documentation immediately before and after the year end relating to the goods from its main supplier should be increased to ensure cutoff is accurate. You also look into some of the shipping documentation. Okay. You verify the cutoff testing. You look into goods at the year ends. You look at proper cutoff testing that goods are recorded in the correct period. How can you look? You look into the shipping documentation and compare. Some shipping documentation says that the goods were delivered in January. Now you go back to your inventory and you check whether in January did you record this good or not. Some says December, shipping documentation, dispatch is December. So you check in December, did you record this inventory or not? So for a sample of inventory, you have to do a detailed cutoff testing using the shipping documentation and also the purchases of the goods at the year end being recorded in inventory. You record whether it's correctly recorded or not. Ensure that whether it's correctly recorded or not. Okay. Check whether if it's correctly recorded or not. Okay. Check if it is correctly recorded or not. Very important. Check if it is correctly recorded or not. The audit team should undertake a detailed cutoff testing of purchases at the year end and a sample of shipping documentation. Right? You do that and see if it's correctly recorded or not. Do all that and see if it's correctly recorded or not. Very important. Okay, that is about this. Do this and see if it's correctly recorded or it's correctly not recorded. This is about the cutoff. While it's in transit, the moment it is dispatched, you should record it as an inventory. Whether you received it or not, doesn't matter. If there is, they wouldn't have recorded, inventory would be over understated, payables would be understated. Okay, next. The central warehouse and 20 branches will be carrying out a full inventory count. It is expected that the value of inventory in the financial statement is 0.95. So what is happening? The entire inventory count is going to happen. So now 20 branches are there. So guys, it is unlikely that the auditor will be able to attend all the 20 counts. So at the same time, guys, 20 branches, you can't be everywhere at the same time, right? Auditor cannot attend all the sites count. So there's a risk that there will be increased detection risk. There will be increased detection risk. Why? Because the 20 branches count is happening. You can't be there everywhere at the same time. So there's a risk that there will be some mistakes in the count that the auditor will not be able to find out and they will oversee it. So what you should do is that first of all you have to decide which are the sites that you will attend. Which of the inventory counts will they attend? First you have to figure out which are the inventory counts they will attend. Okay, the audit team should first assess which is the inventory count they will attend. Okay, first they will assess which are the inventory counts they will attend. Okay, first they will assess which are the inventory counts they will attend. The audit team should assess which are the inventory counts that they will attend. Okay, the audit team should assess which of the inventory counts they will attend. Okay, this should include the count for the central warehouse and a sample of branches. Okay, first they will figure out which are the count they will attend. These should include a count for the central warehouse and a sample of branches, which contain the most material balances of inventory, which have historically and exceptions reported during the inventory count. So first of all, they will see which they will attend. Okay, and for a sample of branches, which contains the most material balance of inventory. Okay, so this should include the count for the central warehouse, so which they should attend. They should attend the central warehouse, and also they should attend those branches and a sample of branches which contain the most material balance, where a lot of inventory is there, that they should attend. For those they cannot attend, the auditor will need to review how much exceptions were found out and discuss the issues which arose during the count with the management. So see, first of all, auditor will attend, few of them the auditor will attend. 2 hours, 3 hours, 3 hours, they can attend one. So which one should they attend? First, central warehouse they will attend. The central warehouse. First, they will attend that. Second, whichever other warehouse or whichever other branch, there is a high amount of inventory, material, a large amount of inventory that they will attend. For which they don't attend, what they should do? They should review the level of exceptions noted during the count, and if any issues arose during the count, they should discuss that with the management. Because see, one person can't be there everywhere all the time. Okay, so wherever they can, they will. But due to geographical reasons or what XYZ reasons, they can't attend all the counts at the same time on the same day. Right? So which they can't, just get someone to do it from the team or get someone to do it, and then whatever the issues they found out. Okay, whatever issues they found out. See, in 20 they can still manage, but a lot of time they have 200 branches, 300, 400 branches. That much auditors don't have a team, right? So for those they couldn't attend, they will ask whatever count their company will take. These auditors are not undertaking the count. Auditors have to be present when the count is being undertaken. So don't get that confused. So if you reach here, The central warehouse and 20 branches will be carrying out the count. Auditors are not carrying out the count. Auditors will not go and count. They will see while the count is happening, they will stand there. Their job is to check. Their job is not to do. So audit team will not do the count. They will assess if the count is happening properly or not. Okay, so the auditors don't do the count. They just assess if the count is happening properly or not. That is the job of the auditor. Okay, that is the job of the auditor, to assess if the count is being done properly or not. Okay, to assess if the count is being done properly or not. That is the job of the auditor. Okay, to assess. Okay. Okay. So we will look into what exactly is the issue with the count. If at all the counts are happening, we will just stand there and we will see the count. That's it. We will just stand there and we will see the count. Okay, the audit team should assess which of the inventory counts they will attend. They should include the count of the central warehouse they should attend and major branches they will attend. But see, every branch they cannot attend. Maybe 20 they could still manage. If there are more branches, it could still be a problem. Okay, so wherever they couldn't attend, they will just see what was the material balance. If any issues were there, they'll discuss it with the management. Okay, moving on. Over the last 6 months, the finance director has noticed that the company receivables is now at an average, which is now an average of 55 days, where the target is 42 days. The credit control is confident that all the receivables will eventually pay, as increase in receivables collection periods are starting to become common in the industry, and is informed the finance director of this. The finance director believes that it's unlikely that any increase in the allowance will be necessary at the year end compared to the prior year. Okay, so what has happened here is allowance for credit receivables. Like, see, basically, when you give credit, some people will not pay. Okay, so you keep some money in the side. That is called allowance for credit losses. Okay, so over the last 6 months, the receivables have increased. They're saying the receivable days have increased. That means people are playing slow, or some people have not paid. A lot of people are not paid only, and there will be some people who are never pay only. There will be some people who will never pay. So your receiver, you have to write that down. So your receivables may be overstated and that allowance may be understated. You have to set up an allowance also. So whenever there is a long time, days are increasing, people are taking more time. That means there might be some people in those, they will no longer pay, because if they could have paid, they would have paid. And now that since they have not paid, the days are increasing and they will never pay only. So you should have write them off. There's a risk that your receivables may be overstated and you should make an allowance also. Some receivables may not be recovered only. And if an additional allowance is not included in the financial statements, then you should include an additional allowance also. Why suddenly you are including additional allowance? Because days have increased. If days have increased, you need more allowance, because there's a good chance that some people will never pay. So you have to write down your receivables and increase your allowance. So here the risk that both would have not have happened. You have to increase your increase your allowance and reduce your receivables. Why? Because some people have not paid, they might never pay. Some people have not paid and they might never pay. Okay, so over the last 6 months, the receivable collection has increased from 40 to 55. Right, this has increased. So what you have to do, you have to increase the allowance. 42 to 55, it has increased. So what you should do, you should increase the allowance. 42 has gone to 55. So it has increased. So what you should do, you should increase the allowance. Okay, what has happened is you should increase the allowance. And you should reduce the receivables, because some people will never pay only now. There's a risk that your receivables are overstated, your allowances are understated. So as an auditor, what can you do? First, you will discuss with the finance director whether any additional allowance will be needed or not. Right? Obviously, it should be needed. Why it should be needed? Because the days have gone up. There's a good chance some people will never pay. Next, review and test the controls surrounding the way in which the finance director assessed that the recoverability of the balance and other credit controls ensure that they are operating effectively. Because the finance director, what is he telling? The finance director is telling no need to increase anything, everything will be fine. So you will say, okay, sir, how did you come to that conclusion? Tell me, what control did you check? You are telling me don't need to increase the allowance. Okay, agreed. But how did you come to that conclusion in the first place? Give me some proof. Right? Give me your assumptions. Give me the controls that you looked into. How did you exactly come to this conclusion? You tell me that first. Okay. So what you will do, you'll perform the extended post-year-end testing and cash receipts testing, and you will review and aged of the list of individual customer balances in order to assess the valuation and the need for an allowance. So you will do post year end cash receipt testing, that after the year end did some people pay, and also you will review the aged list of individual customers balances. Age list means it's a list. 0 to 30 days, these people have not paid. 30 to 60 days, these people are delayed. More than 60 days, these people are delayed. Go through that list. Go through that list. Okay. Next thing is you have to go through that list. And if you go through that list, you will understand, okay, so many people have not paid for 30 days. So many people have not paid for 60 days. So many people have not paid for 90 days. And after looking at the list, you should assess, do you think they need an extra allowance for receivables? After that, looking at that list, you determine that should they need an extra allowance or not? Would they need an extra allowance or not? Okay. Would they need an extra allowance or not? Okay. Look into, would they need an extra allowance or not? Okay. Look into, would they need an extra allowance or not? Okay. Look into whether they would need an extra allowance or not. Okay. Look into whether they would need an extra allowance or not. Okay. Look into that. Would they need an extra allowance or not? Okay. Discuss with the finance director. If you think they will, discuss with the finance director and tell him that yes, we would need an extra allowance. We would need that. Discuss with them. Okay. That is about this. The first is allowance for credit losses. We got that. Okay. We got an allowance for credit losses. What are the allowances for credit losses? We looked into that. Then we looked into if any additional allowance is not required, and receivables will be overstated and the allowance for credit will be understated. Okay, allowance for credit losses. Okay, first we looked into the allowance for credit losses. From 42 days to 55 days. We looked into the allowance for credit losses. Some receivables may not be recovered if an additional allowance is not included in the financial statements. Then receivables will be overstated and allowance for credit is understated. Okay, this is your allowance for credit losses. Why do you need an allowance? Because people are delaying. How do you know? Days have went from 42 to 55. So you know you will have to make an allowance. They would have not made, that's the risk. So receivables will be overstated. Receivables also you should write down, allowance also you should increase. Is that they would have not done that. Why finance director is telling no need to do? So you ask him, okay, discuss with him that what are the controls that you looked into, you assess those controls and then you come to a conclusion. Do you think they need it or not? And if they need, you to tell the finance director that yes, they will be requiring an older balance. They will need to increase the allowance. Also, go through the controls and test the controls based on which the finance director assess the recoverability of the receivables. On what basis is he saying that we will not need to increase it? So go through those controls and check everything. Okay, so that is about this. These 4 of them are there. We'll be able to close it tomorrow. So again, a lot of things are repeated, guys. If you see here, a lot of things would be repeated. Warranty provision and your cutoff. Warranty, inventory count. It comes so many times. Now, as we do the sum regularly, as you guys are attending regularly, and you're seeing more sums happen, you will see every day that similar points will be repeated. That will be a big benefit. Okay, so as you do more and more questions back to back and you attend every day, you start seeing